Welcome back to our Intermediate Financial Accounting course, our special lectures about time value of money. Now so far we've talked about the general principles of time value, we've talked about the general principles of interest, and yes, those puns are totally intended, and we've done some basic examples of time value. We wrapped up our discussion last time by talking about business and accounting use of time value concepts, and now it's time to do a real business style example, and that is working with bonds. Now bonds provide a special challenge and therefore really good practice for us because they have multiple components. Not only do we have a lump sum that gets paid at the end of the bond's useful life, but we also have a series of interest payments that are made between when you buy it and when that final payment comes back. Which means we have both a lump sum and an annuity. So bonds are awesome. They give us both pieces. From a business perspective, the question with a bond is, should we purchase the bond? Or the opposite question could be, should we issue this bond? Is it a good deal for us? What should we do? From an accounting perspective, we're doing journal entries. We assume the bond is issued or that we've loaned out the money. We make those journal entries. We'll deal with those in our other lectures. So for now, we're going to focus on the business decision. Should we invest or should we not invest in these bonds? So let's look at the steps involved in deciding the value of bonds, and this is really just an extended version of the steps we've already talked about in coming up with present values and future values, etc. The very first step to valuing a bond is deciding whether it's going to be issued at a discount, at premium, or at par. For those of you who have already watched our discussion of notes receivable, we've already gone through this, so this is going to be a bit of a review. If you haven't watched that piece yet, then it'll be a review when you get there. So either way, you'll get a good review of this concept. The basic idea between discounts, premiums, and par values is what are we willing to pay to get this bond? The best example of this that I've been able to come up with are football tickets. Imagine for a moment that all football tickets in the world are $100. Flat. Every seat, every game, everything, $100. My question is, would you be willing to pay more than $100 for a ticket to the Super Bowl? If you would, that's a premium. Why? Because I'm willing to pay extra for the game, for the reputation of the teams, for the experience. I'm willing to pay a little more than the stated value, the $100, because of the game that I would get to see. Now, let's think of a team that maybe isn't doing quite so hot. Take the University of Idaho, for example, that's had some trouble with their football team for quite a while. Would you be willing to pay $100 to go see a University of Idaho football game? Chances are the answer is no, unless you're an alumni, and in that case, good for you. You can go ahead and pay that extra money. They'll be thrilled to get it. But for most of us, we wouldn't pay $100 for a ticket to that kind of game because it isn't worth it to us. That's a discount. It's not worth it to us because we could do better. We could take that $100 and go to a nicer game somewhere else. So we're only going to buy those tickets if they'll sell it to us at a discount, at a lower price, at a sale. That's what we're talking about. Now, if you've got a team that you love and you have an opportunity for tickets and you're willing to pay exactly the $100, that's a par value. Now, these same principles apply to the purchase of bonds. If the bond stated rate, the interest rate it's actually going to pay, it's in the contract, is higher than the market interest rate or the effective rate or the discount rate that your company uses, then you're willing to pay a premium. Why? Because if I can get 10% everywhere else and you're offering 15%, I'd be willing to pay you extra to get that 15% interest rate. If the stated rate is lower than the market or effective or discount or IRR, whatever you want to call it, rate, then I'm not willing to pay the full price. Why? Because if I can get 10% over here, why would I give you my money and get only 8%? Instead, I'll give you 80% of the value that you're asking for, and then I'll make my other percentage points back with that extra you'll give me at the end. So if I give you 80 now and you give me 100 later, I get that extra 20 as a form of interest. And that's what I'm doing with a discount. The last is par value. If the two interest rates are the same, if I can get 10%, you're offering 10%, then sure, I'll give you my money because then I get to make my 10% from you as opposed to maybe a riskier investment somewhere else. So that's par value, discount, and premium. And the very first thing we're going to do in deciding how to value a bond is decide, is this going to be a par value, a premium, or a discount? And we're going to write that off to one side so that we know how it's supposed to end out when we're done with our calculations. Next, we're going to gather some information, and you'll notice that this is pretty similar to what we were doing before, a little different. Now that we're dealing solely with business decisions. We're going to get rid of the whole future value question. Everything's going to be present value for these couple of minutes while we're doing these examples. I'm going to call this, instead of principal, the face value of the loan. What does it say in the contract that I'm going to get at the end of the term? Next, I want to know the stated interest rate. Then I want to calculate the value of the interest payments that they're actually going to pay to me. Then I'm going to figure out the number of payments that will be made, the number of periods, and finally I'll get the market rate or the effective rate per period. Once I've got that key information, then I move on to calculating the present value of the interest and the present value of the principal. I add them together, and that's the value of my bond. And I'm not done. Last thing I do is I check my total with what I thought I'd get. Did I come up with a discount? Is it less than the face value? Did I come up with a premium like I was supposed to? It's more than the face value. Always make sure you check that, make it part of your steps, because the number one mistake is flip-flopping interest rates. And if you flip-flop interest rates, then when you think you get a premium, you'll end up with a discount. And then you'll know, whoops, I blew it. So make sure you perform this check. Now that we've gone through the steps, let's take a look at an example so that we can really see how this all comes together to give us bond values. So here's DGS Incorporated. They're trying to invest in a new bond so that they can open their new production plant. They've got to save up some money. So they've got an effective rate of 10%. So this is what they could make with their other investments. We want to know whether or not they should invest in any of the bonds in this set of options right here. So we've got 3 bonds, 3 possibilities. We've got to decide whether we should invest or not. So let's start with step number 1, and that is to decide premium, discount, or par. So bond number 1 pays 6%. If DGS can make 10% somewhere else, would they be willing to pay the full face value, or the $100,000, to get this 6% bond? The answer is no. If I can make 10% somewhere else, I will only pay this if they offer it to me at some kind of a discount. Bond 2 pays 10%. I can make 10% somewhere else. I can make it here. If they offer it to me at $300,000, will I pay the $300,000? The answer is yes. So I'll pay par value, or the full amount of the face value on this bond. The third bond pays 16%. Well, if I can only make 10% somewhere else, would I be willing to pay $550 for this bond? I would. I would even pay a little bit extra because they're paying so much more than I can make anywhere else, and that's a premium. That's the first step. Let's go ahead and take a look at my other steps and get the values of each of these bonds. And we're going to do this one at a time, starting with bond number 1. So bond number 1, let's get its information, and I'm not going to flip back and forth. I'm just going to give you the information again. If you need to print out that previous slide so you've got this as we go right ahead. But our face value of this bond is $100,000. That's what they're asking for it. And before I go on, let me just remind you, we said this was a discount. Next thing we want to know is the stated interest rate, and for this bond it was 6%. Next I'm going to calculate the interest payments. So to do that, I take the face value times the stated rate divided by the number of payments per year, and this is an annual bond, so I divide by 1, and I get $6,000. Now, this next step you don't have to do. It's something that I always do. We said that the most common mistake is mixing up the interest rates. So I'm done now with stated rate. I've used it to figure out that it was a discount. I used it to get the interest payment, so I don't need that anymore. I'm going to scribble it out so I don't accidentally use it somewhere else. N is going to be 10, it's a 10-year bond. 10-year bond, annual payments, so I don't have to multiply it by anything. The final piece of information is to get our effective rate, and that's 10%, and again it's annual, so I can just leave it at the 10%. So that's my information. Now I'm ready to do my calculations. So I start with the present value of the interest. Interest is $6,000. Present value of an annuity factor, N is 10. Interest rate is 10%, and I need to go find this factor. So we'll switch to our table, and let's see here. 10N and 10% gives me 6.14457. So 6.14457. And if I multiply that out, I get $36,860. 7. Now we'll do the present value of the principal, or the face value. Face value is $100,000. Use the present value table this time. It's a lump sum, 10 periods, 10%. Now we need to go get this value. Just make sure it's a present value of $1, and it is 10%, 10 periods, 0.38554. And if I multiply that, I get $38,554. So now I can calculate the bond value as the present value of the interest plus the present value of the principal. Now, before we go any further, let me take a second here. This is step 1. This information here is step 2. Getting the present value of the interest is step 3. Present value of the principal or the face value is 4. Present value of the bond is 5. And the last step, step 6, is to compare the $75,000 with the $100,000. Is this a discount? It is. It came out to less than the $100,000. And the question now becomes, should I invest in this or not? And the answer is, well, if DGS can get this for less than $75,421, or for exactly $75,421, they should do it. If not, then they shouldn't. They'd be better off taking their money somewhere else. And that number becomes a threshold for business decisions. Let's go ahead and do bond 2. As far as our basic information goes, we want to start with the face value. Oh, whoops. First we need to say up here, this was going to be a par value bond. Face value is $300,000. The stated rate is 10%. The interest payments, $300,000 times 10% divided by 4, because they're quarterly payments. So this is 30,000 divided by 4 gives me interest payments of $7,500. And just like I did last time, I'm going to scribble this out because I don't want to accidentally use that interest rate anywhere else. And it's a 5-year bond. Payments are made quarterly, so I will have 20 payments or periods total. My market rate, or DGS's interest rate, is 10%, but that's annually, so I'm going to divide it by 4 and get 2.5%. And you'll have to be careful as you look for a present value table that you get one that has 2.5%, and you can find them. They're pretty straightforward to find 2.5%. So again, you have them in most accounting books. You can find them online. But take this information and go ahead and calculate the present value of the bond and check to see if it's really par value. It's a par value bond. That's how we said it should issue. And sure enough, we get $300,000 if we do it correctly. So it worked out just the way we said it would. Rather than going through and doing this last problem together, I'm going to let you do it yourself, have it all ready to go, because when we come back in our next segment, I'm going to show you that value. And then we'll talk just briefly about premium bonds. And we'll move on from there. We'll see you then.